G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm really glad you're joining us today because we have an awesome guest coming all the way from the UK, Akhil Patel. Welcome to the show, mate.
Thank you so much for having me.
Mate, I really appreciate it. I know it's an ungodly hour in the UK, so
It's fine.
yeah.
It's 20 to 11, but that's good.
And you're still firing on all cylinders, mate. So we're
Yeah,
gonna
absolutely.
pop the hood on your book, which is the Secret Wealth Advantage. Now, I picked this up, and yeah, as you do, you go into a bit of a rabbit hole about this, and I feel like I'm the eternal optimist. So for me, having failed economics an embarrassing number of times at university, and then picking up your book, it's quite confronting. But for those that are unaware, we're going to go through what they call the 18.6 year property cycle. And Akhil Patel, Director of Property Sharemarket Economics. So I guess you are leading research. You're also working, I guess, on education as well for your community. So I'd love to talk a little bit about what you're doing and how you deliver your message effectively with the people that are engaged with your work, and learn about yourself personally and professionally, if that's okay.
Absolutely. So, it's quite interesting. You talked about not finding economics that easy. Truth be told, I've never had one single minute of formal economics training at all. So this is all kind of interests, sort of self-taught. And it sort of started in the global financial crisis, like a lot of stories did.
Yeah.
I became interested because my family's business had a really difficult time, and I thought it was crazy that we couldn't have been prepared. No one was telling us what to do and stuff, and it really affected us quite badly. So I thought, I'm going to find out what the reason is. What are people not seeing? What should we do next time there's going to be a crisis? Because it seemed pretty clear to me that there would be another crisis at some point. And I remember the recession in the early 90s quite clearly. And I thought these two episodes, the 90s recession, the global crisis, was quite kind of linked. Anyway, I had a background in the classics, so literature and history and so on. And so I think that sort of put me in good stead for seeing patterns in things. And sort of professionally, I'd worked as a UK civil servant. I also work in international development finance. And so, I'm in and around the kind of financial industry. I kind of sort of familiar with the terminology. And so I think the combination of all of those things kind of put me in a position where when I started looking into these things, it became quite an interesting kind of mix of various different interests of mine.
Yeah. I mean, you glazed over that, the fact that you studied classics at Oxford, by the way. So I'll throw that in there. It's extremely. I mean, you got to be super proud when you look back, I guess, at your career and where it's taken you, where you got now. It's obviously you connect the dots looking backwards, but at the time you go, family's back against the wall. You're studying something completely left field, and now you moved into an area that you, like you said, super interested in. And that's probably what makes you exceptional at what you do when you've got that. I guess you're so devoted to your craft.
Yeah. I tell you what, the interesting thing was when I sort of left university, I was quite keen to keep on learning, but I picked up a lot of things and I put them down again, and nothing really seemed to get my interest for very long. So I looked at Jungian psychology and leadership and management and various things like that, anthropology. All these are really fascinating areas, and actually some of them I've come back to. But once I got into the idea of cycles, I kind of picked it up and I've really never put it down. So that's obviously a good sign that I was doing something I'm probably supposed to be doing. Yeah. And it's been quite a journey since then.
Awesome. So to give our listeners a bit of context and a bit of a frame for today, look, I see my role as a way to inform property investors. I look at a lot of our investors who are trying to get to that top 1%, so 6 or more properties. They're ambitious, but also very, very curious as well. So what we're trying to do is make educated decisions about investing in property, so knowing the risks and the rewards as well. So I feel like that, if it has that as a foundation for today, that's why we've got Akhil coming on. I just want to start here, Akhil, and talk about the fact that you've been looking at cycles for quite some time. So I'm going to read this out. So in 2001, yourself and Philip J. Anderson called the 2007 top before the GFC. That's 6 years in advance. 2007 called the 2009 low and stock market recovery. 2010, when the world called for another crash, They said it was impossible. So you guys said it was impossible, and you were right. In 2016, called the stock market highs for 2019, with a market panic and a short-term recession in 2020. In 2020, you guys said property was not going to go bust, that not even a global pandemic could force property prices to head downwards, but rather property would boom. And this is when American economists were calling for the worst recession since the Great Depression. So my question here is, it's not how did you pick this up, but what indicators were you guys looking at that you could see a trend start to emerge?
Yeah. So, I mean, the fundamental part of all of that, the common theme through all of those sort of forecasts and predictions is sort of understanding the 18-year kind of land cycle. And I say land cycle because really land which drives the economy. It's sort of everything requires a bit of land to work. You need to be located somewhere. It's the essential asset, and it's also scarce in supply. And while I appreciate you're sitting in Australia, which is I flew over Australia a few weeks ago from Perth to Melbourne, and you have a lot of land, and you
a lot of land.
think it's not particularly finite, but it's land in locations where people can cohabit and interact and do business together, and that's fairly finite. The middle of Australia is probably not the place you need to be for that kind of stuff. So it's finite, it's essential, and it's sort of it's not man-made. It's freely provided by nature. It's a very locational asset, and it's the foundation of the economy. And so if you understand what's going on in the land market, you can understand the rhythm of the land markets, and this is what drives the 18-year cycle. You can actually make some pretty clear predictions about what's going on. So, for example, when you get to the end of the cycle and you can see land prices coming down, but maybe other things are doing well, actually this is the time when you should be sort of being careful. And similarly, when you don't see land coming down, but everyone's panicking, actually, while there may be some short-term problems in the economy, it's not going to be very severe because the banking system won't be affected too much, and they'll continue lending. And when governments enact stimulus packages as they did during the COVID pandemic, they're actually going to be quite effective and will potentially turn things around quite quickly. So once you understand that kind of rhythm, then you can fit all these other surface events into a bigger picture, and it gives you the ability to, I think, make some fairly robust short and long-term forecasts.
Yeah, wow.
And so there's nothing particularly sophisticated. I suppose also what I'm trying to say, it's understanding that kind of thing and how it fits together.
Yeah, I mean, it probably comes better to you because you've done so much research. So when you say it's not particularly sophisticated, when you pick up a book and you've got 260 pages worth of research and data and graphs and charts and insights, there's a lot of work that goes into that, and especially putting something out there that's, I won't say controversial, but you've got to stand by your message, and there's a level of conviction that comes with that as well.
Yeah, no, I have a strong conviction, and I've been writing about these things for a number of years, and I don't think in any kind of major fundamental way either about how the cycle would unfold or indeed the timing of it. I don't think I've really deviated at all. I mean, obviously events come around and you might refine what you've said before, but I think I've been pretty consistent for more than a decade. I mean, sort of within, I sort of described earlier the sort of rhythm, the land cycle rhythm. Then once you understand that, you can then look at how different asset classes behave within the stock market and different parts of the property market and gold and other things, commodities. And then you can start to, sort of understand how they might behave in relation to that. And then you can use that kind of understanding to then kind of keep you on track. So when you say indicators, it's also, it's property, it's sort of interest rates, it's the yield curve, it's what's going on with gold, it's what's going on within specific subsectors within the stock market and so on. And what I've tried to do in the book, as you have, you've kind of, well, you maybe didn't allude to, but might get onto how the book is structured. I've tried to leave some practical insights at the end of each chapter, and they cover common themes throughout. So commodities and property and the stock market, and in some senses, these are all the kind of bits and pieces you can use to help you track where we are in the cycle, and also to use in a practical way for your investing.
Yeah, beautiful. I'm going to come back to the structure in the book because I really liked exactly that, what you did at the end of each chapter, going, these are the metrics, or these are the indicators to watch out for as well. So we're going to come back to
Yeah.
that. But you did mention before that you came to Australia, and I'm
Yes.
very intrigued about it because I knew you were down in Melbourne. I think we almost tried to catch up at that point. But so I'm going to zoom out a little bit and talk about some property bears. So you got Kiyosaki, for
Yes.
example. It's Harry Dent as well, well-known
Yes.
commentator, and they look at the Australian property market, going, "This is madness. This bubble has to burst." And
Yeah.
everyone on the ground here is going, "That doesn't make any sense." So if I kind of rewind time, we've had record low rates that moved. You talked about the fixed rate cliff that we've had in Australia that kind of rolled off at some point last year. We've had 13 interest rate rises as well, and yet with that, the property market did nationally 7% increase last year. So people are going, these property bears continue to get the market wrong. Economists here can't even seem to get the RBA rate movements correct either. And I guess for a lot of our investors and even home buyers in the country, they're left confused, perplexed, going, I thought the market was going to slow down, and yet it hasn't. And yeah, that's not true for every single property market across
Yeah.
Australia, but nationally, we're on this trajectory that other people can't seem to understand or get their head around. Yeah, right. So Sydney's the second most expensive property market in the world, but we're the fifth sparsest populated country in the world as well. So when you came to Australia,
Yeah.
has the property market surprised you, or do you go, this is acting kind of how we see the framework play out as well?
Yeah, I mean, the framework plays out actually very well in Australia. I mean, I should say by way of preface that really everything is sort of led by the US, the biggest market, maybe not quite the biggest property market, but the biggest property market that's kind of normal, as opposed to say China, which is a fairly abnormal one in some senses. But Australia kind of follows the US pretty perfectly, and it plays out in similar ways. I mean, the reality is that every single era, people think property prices are crazy. I mean, it's not something that's just started. You go back into the 2000s, people were saying the same thing, and if you were in the 80s, they were saying the same thing, right? So I think that's the first thing to remember. The second thing is one of the metrics of how unaffordable property is its price in relation to the median wage, and it just seems to go up and up. But even then, like if you go to places like Hong Kong or China, what they pay for property in relation to median wages is far higher than it is in Australia. So there's no absolute level at which property is just simply, people can't afford it. What it is that people tend to do what it takes to get onto the property ladder because they see that's where the kind of the value is, or the values of our society is to be a property owning democracy. And so you want to get on that. And so you forego spending money on other things. You buy a smaller place than you would otherwise buy. You'd buy further out and so on. You buy as a couple, you buy later in life, etc. And so, there's no kind of absolutes in this sense. Of course, property is ridiculously expensive, but you can't say that it's unprecedentedly so because we have this concern every single time. And the reality is that once you're on the property ladder and you then upgrade to a bigger house, or you start a family and you want to have this garden and all that sort of thing, you're trading up your sort of housing equity. And so the really key thing is getting first-time buyers into the property market. I mean, you could think of it almost a bit like a giant Ponzi scheme in the sense that you need new buyers to keep the whole thing going. And this is where, when you have these concerns about affordability, you find governments and banks, what they do, the primary intervention they make is to support first-time buyers. So they give them sort of discount windows on mortgages. They give home buyers grants. You get, you don't have to pay stamp duty. There's something that happens in the UK. You pay stamp duty on closing a property transaction. That was, that goes away. You get sort of forbearance on certain things. And so all of that enables the thing to keep going. And then people do, they save up, they spend less, and they do what it takes to get on. And it just keeps going until the whole thing comes crashing down.
Yeah. Yeah, thanks very much. I appreciate it. And again, you've been to Australia recently. Everyone seems to think they're an inflation expert at the moment. They're reading the data and waiting for it to come out all the time.
Indeed.
How do you see inflation playing out globally? How do you see that kind of stack up locally here in Australia versus other markets
Yeah.
in the UK, US, Canada?
Yeah, I mean, it's funny because everyone was a sort of epidemiologist during the pandemic. We all sort of seem to understand how viruses spread and so on. Yeah, look, it's the thing to talk about. I think in Australia you had less inflation than say in the UK, which is where I'm based, and maybe even the US. I'm not entirely sure why, but it was nonetheless quite significant. Central banks decided that um, they had been part of the problem, I think, with really ultra low interest rates out of the pandemic. I think also all the enormous stimulus packages that came in, to keep people going, when the economies were closed and so on, it boosted savings to record levels, and then also at all of that happened at a time when the global economy was disrupted. It was much harder to get stuff, and so on. And so that I think was a fundamental cause of inflation. Central banks, I think, panicked. They raised interest rates, but I'm not sure, to be honest, that what they did has actually affected inflation. I think it may have come out anyway. What they've done is they've caused a lot of other problems in the economy. I think it's just been a bit of a fiasco, if I'm really honest. But nonetheless, we live in the era where you have to do something, otherwise people think you're useless and you deserve to be sacked and so on. So, as you can tell, I'm a bit cynical about all this kind of stuff. Inflation is coming down. I don't think it's going to get anywhere near where it was kind of during the early days of the pandemic or just before the pandemic. But I do expect interest rates to come down a little bit next year, not particularly further down than they are. I think that might then start to put even more heat into property markets and so on. So if anyone's waiting around for a crash, I think they're going to see an acceleration before you see a crash. And so I'm probably slightly rambling. I'm not sure if I've totally answered your question. But
this is exactly that last point is exactly what we want to double down on, because
okay,
you see this acceleration before a crash, and I feel like there's so many people that
yeah,
that are sitting on the sidelines waiting for this crash. Now, there's two parts to this.
mm,
One is, where are we in this like acceleration phase, and then the next part
yeah,
is, how bad is a crash going to be?
yeah. Look, these are really good questions. So if we're just sticking to property,
Yeah,
I mean, it's important not to generalize too much because property is inherently a locational asset, and what's happening in the centre of Sydney will not be the same thing that's happening at the edge of Darwin,
yeah,
for example. With all due respect to people at the edge of Darwin, it's just a slightly different property market to the centre, the Sydney CBD, right? So bear that in mind. Now, I do think there is money on the sidelines. I think there are people who are, waiting to get in. They probably would ideally hope that things do crash. But also, if interest rates do come down, or there's more competition between banks for lending for people wanting to buy stuff, which, after all, lending for mortgages is a very lucrative activity. Banks, they should, they are wanting to do more of it if they can get past the regulations and all that sort of thing. They won't see property prices come down, but they might find a purchase a bit more affordable, and then they jump in the market at the same time. And once people start doing it at the same time, that puts heat into the market. I mean, you're already probably seeing this as of last year in Australia and the UK and the US, certainly. The US maybe the start of last year, UK and Australia, I think kind of maybe further through last year, or depending on where you were. People jump in the market at the same time. Then other buyers start to panic because they see the market going further away from them, and they start to get in as well, and it feeds on itself. And then when you have a seller's market, i.e. sellers have the sort of bargaining power, they can hold out for higher prices. That puts less supply into the market at any given time, and so people have to bid it up, and it just kind of feeds on itself. And so that's how an acceleration can start, even if interest rates are still relatively high compared to where they were a few years ago. Um, and people trading up, they can see their housing equities increase, so they can consider moving to other places, etc. So um, I think that's kind of what happens before, and typically what happens towards the peak of the cycle, um, because there is just inherently a huge amount of demand in the marketplace, and it hasn't really been satisfied, and people are waiting, and the economy is looking good, and um, people have money. The stock market is doing well. People feel wealthy. People are spending money. It all kind of feeds in on itself. It creates a certain sentiment, um, and it sort of all kind of comes together in the ways that I've described. And sorry, you did ask about my trip to Australia.
Yeah.
One of the things that is an indicator of all this kind of positive sentiment, and I was in Melbourne during the Taylor Swift sort of concerts, and that actually, in a way, is a sign of the times. And I don't mean to be sort of flippant about it. I mean, these are really huge economic events for Melbourne. But you see all these people, with their kind of sequin kind of outfits and so on, really getting into it. And these tickets were enormously expensive, and Taylor Swift has done the first $1 billion tour and so on. I mean, this is all fundamentally a sign of where we are in the cycle. You certainly wouldn't have seen anything like this in 2010, in the aftermath of the global financial crisis. It wouldn't even be conceivable, and if someone had come up with it, they wouldn't be paying these sort of prices. All the sort of concert venues wouldn't be sold out. And so it's a sign that people are willing to spend. They're thinking about having a good time, and that sort of positive sentiment affects investing in different assets. You might think they're totally unrelated, but it's the mood is very important in investing, because investing is fundamentally an emotional activity.
Yeah, it's a very interesting one. And then how does, because you're saying that it's all linked before, like gold versus property versus shares, for example. So how is the property market linked to, say, the share market, for example, and what correlation do you see there?
Well, I mean, the kind of share market rides the property or land cycle up and down. So you tend to find, I mean, they're not totally timed in the same way. The stock market tends to lead at the start of the cycle, and so may bottom before the property market does. And I appreciate that Australia's experience after 2008 might be slightly different to other countries, but we can come on to that maybe a bit later. But the stock market leads. It runs up, the way that the cycle is structured, an 18-year cycle, it tends to be 2 7-year halves of expansion. There's a mid-cycle recession in the middle. So you get the first 7 years, then the mid-cycle recession, then the second 7 years of expansion, then 4 years of crisis and crash and trying to sort it out. The stock market rides those expansionary halves up to a peak. And so it's related in that way. It's related another way because most companies that are listed on the stock market have very large property holdings, and so that affects their valuations. And it also affects the fact that when people's housing equity is going up, they tend to spend more, which of course is better for business, which affects the earnings of companies, particularly consumer companies, and all these sorts of things. So they are fundamentally linked in that sense. And of course, very important to the property market is big house builders and companies that are providing ancillary services, and of course also the big banks. And I said earlier that mortgage lending is a very lucrative activity, and so when banks are doing a lot of that, they're earning a lot in terms of profits, which means their share prices are going up. And similarly, when you get to the end of the cycle, when the banking system comes down during the crisis, the shares of banks really tanks, and it brings down the stock market as well.
Yeah, okay. Thanks, Rod. Now we go to, say, that peak period, and it's I think you're looking at maybe, say, 2025, 2026, thereabouts. And it's dubbed
Yeah,
the danger zone. But again, I'm going to look at the Australian property market, and this is what we're seeing on the ground. So we've got low construction happening. We're like
yeah, It's really apparent, Melbourne and Perth and so on. It's really apparent.
right? So you've got like the
Yeah.
low construction going on. So supply's drying up, and you can see we're at 12-year lows at the moment. There's a high migration rates of people coming into the country, flocking in, which then creates a whole raft of demand for rental properties as well. I speak openly that all the statistics point that migrants will buy their property within the first 5 to 10 years. So all this influx of migration that we've had is just building up demand in the next 5 to 10 years on top of local demand. And then we've got, you see it, the great Australian dream, a desire to own their own home. They'll do anything they can to get into the market. Banker mum and dad has really, really shown up as well. And plus, we have very unfriendly rental laws compared to, say, Europe as well. So my question is, how confident are you that we hit that peak period? You go, look,
Yeah.
I want to say it's a guarantee, but how confident you'll hit that? We hit that danger zone, and then what's the worst case scenario that we see for Australian property?
Yeah, it's a good question, and this is really kind of crystal ball stuff, isn't it? Yeah, no, I mean this is exactly the sort of value of trying to think it through in advance. Look, I mean, there's a couple of things to say about migration figures in general. I mean, Australia, I know, is a growing country, and people are wanting to live there and so on, and it's absolutely the fact. But migration flows aren't sort of continuous, and they do fluctuate and so on, and they are subject to a number of assumptions, and they're people are very authoritative about how much undersupply there is and so on, not sort of necessarily taking into account the fact that in any given city, I think someone in America did some research about 10 or 15 years ago, sort of showing that in most American cities, the number of empty buildings is at least sort of 10% and so on. So there's maybe a bit more stock than is apparent, but it's just that people are holding on to, they're not putting in the market, etc. So some of these things are subject to factors which aren't normally talked about. They talk about in absolute terms. The other thing is that people might assume you might be absolutely right in terms of there being an undersupply, but then people make assumptions about where that demand is going to be. And they might say, well, it's going to be the edge of this place, it's going to be this new suburb, it's going to be here, it's going to be there. And then builders come in and they build there. But actually, if there's even a slight variation in what they're expecting in the flow of inward migration, it can actually really negatively affect their ability to sell, which, if you're a builder with stock owing money to the bank, I mean, even 6 months can be a real problem. Or if you have to take a 10% cut on what you expected, I mean, that can really hurt. So particularly if you're over leveraged and you've paid too much for the land and so on, which you typically do at the end of the cycle. So this kind of means that you might not, what I'm trying to say is you can be out by not that much and have a serious problem as a person in the property market. Now, the other thing is that, as I said, property is an inherently locational asset. And so if you own half of the centre of Sydney and so on, Sydney being what it is, along with Melbourne, the largest city in Australia, where most of the business and the wealth is generated. Well, maybe not most of it, because Australia has a lot of wealth generation in Western Australia. But you know what I mean in terms of cities.
Yeah.
There's always going to be inward demand for those places, and it's probably never going to go down too much. But that's not really where the problems start in terms of an economy. It's usually what happens at the peripheral, the edge of cities or tertiary cities or secondary cities, where people have built too much, where prices can really collapse. So Sydney might not go down in much. 10-20% is what we have as a rule of thumb for a well-located area. But in some areas where there's been too much building, there's too many apartment blocks, there's not the inward demand, or it can dry up quite quickly, things can really tank. And I think my understanding was even in 2008, 2009, when Australia as a whole didn't actually experience much of a slump, and even I think my friend Phil says that Melbourne property prices even increased in 2009 when the rest of the world, it was coming down. If you were at the edge of Darwin and you were trying to sell something that really there was no buyers for, I mean, you really had to take a massive cut. So it sort of depends on where you are and what you're doing and what's going on around it. And I know that's not particularly an answer, but if you are a property investor, it doesn't matter what's going on in general. You need to know what's going on in your particular location, and so you have to be quite careful. But as a rule of thumb, I think there's two things. You don't want to be a forced seller in an economic downturn, because you lose negotiating power, and even in an economy that's not doing too badly, it's going to be quite painful, and it might force you to to be underwater on your in terms of your mortgage and so on. You might have to sell other assets that you don't want to sell, and so on, and that's where the problems really start. As a general rule, expect sort of 20% in real terms, and be able to withstand that for a few years. So you don't have to sell in that period. You can still service your loans and so on. But don't be the sort of person who's over leveraged into the peak. Be forced to sell when the bank calls in the loan, or to be building or investing in areas where there's a lot of new supply coming on in not that big locations. I think these are the sorts of rules that you need to, and I've tried to put it in my book, which you need to apply to your specific circumstances, because really that is the key thing as a property investor.
Awesome. Thank you very much. And that's my next question here is, if someone's coming in and you've got a few cohorts of buyers or property owners at this stage, right? So you've got people that are trying to get into the market and going,
Yeah.
do I wait for this, call it best case scenario, 10, maybe 20% correction? Or do they get in now, hold through that period, like you said, make sure that you batten down the hatches and you can ride that time and the volatility? Or do you get in and get out, for example? And there's obviously costs attached to that too. So, I mean, they're the kind of options that I can see for people that are trying to, I guess, because you've got this catch cry, time in the market versus timing the market, and it feels like this kind of brings that to the boil, right?
I mean, people do sort of flip properties when you get to the sort of final stages. You find a location that's just going crazy. I mean, you might be able to buy a place, give it a lick of paint, and sell it 6 months later for sort of 20% gain. And you might have borrowed most of it, no money down and stuff. You actually might be very lucrative, but you don't want to be doing that right at the end. And in any case, you've got to be really on top of it. And so it's probably not for most investors. Personally, I do other things with my time. I don't have the opportunity to kind of be out there sort of always in the market and finding on what's going on and finding buyers and so on. I would, obviously the best time to buy in the cycle is right at the beginning. But if you are just getting into the property market now, it's actually fine, as long as it's a good asset, good location, well built. There's infrastructure going in, people are coming in. You can see new businesses starting. It's desirable. All those sorts of things that make it a good kind of location. If you're not over borrowed, if you've got a stable source of income to cover your sort of mortgages and other things, and it's relatively secure, or you've got a buffer of you ride out any problems, then fine, do that. I think there's no point waiting, and there's no point thinking I'm going to buy it now and I'm going to time it such that there's going to be time to get out, because property is also it's illiquid, it's difficult, it takes time, particularly if you're trying to sell at a really high price. That makes it harder to sell quickly, and you may get the timing wrong, because not everything peaks at the same time. Some areas may peak before others, and you might be in one of those areas where you've maybe slightly missed the boat. And the problem is that you saw that your neighbor sold for 20% more 6 months ago, and you're holding out for that 20%. You're not prepared to come down 20% if the area is coming down, and that makes it harder to sell. And that means that you might end up sort of being stuck when things come down a bit more. So really the answer is it depends on your circumstances, but those are some of the considerations that I think you should apply.
Beautiful. Thanks very much. When we talk about the winner's curse, so you get right to that peak period, for example, someone looking at the market, what are the indicators that they should be seeing and identifying, going, I feel like we're there, and their telltale signs?
Yeah, I mean, I cover the sort of hedonistic behavior, sort of
Yeah,
Taylor
I thought if
Swift
someone
kind of
hasn't read
thing.
the book and
Yeah, yeah, it's
we'll
sort
give
of
away a
where,
copy, but yeah, it's
the winners, we talk about the tall buildings or the kind of crazy schemes. And actually, if you watch closely, there are quite a few of those around. I mean, a lot of them, people talk about the Middle East, and sometimes the newspapers like to jump on the kind of crazy Middle Eastern countries. They're doing all this ridiculous stuff, not sort of realizing that actually there's some things going on closer to home.
yeah,
So you look for these sort of grand schemes, which you think are very costly, and maybe they won't really sort of return the money that people think they will. Um, you see a lot of you get your bank managers chasing you to take out a loan because they haven't met their targets, that sort of thing, pushing money into the marketplace. Um, when you really get to the peak, you go to your hairdresser or your barista as now a property investor or a stock market trader or a crypto millionaire and so on. You hear that kind of talk. Um, or like I have a friend who lives in Malaysia, but in 2008 he was living, I think, in Dubai. And he went home. He's from originally from the UK. He went home to London for the holidays or something, and everyone was asking, "Oh, should we be buying in Dubai?" And he thought, "Oh, this is clearly it's gone over the top," because even people who have got no connection to the city are thinking that that's where the action is. So those are some of the signs that it's become a sort of a popular mass sort of entertainment. You see property programs on TV, really hitting the prime time kind of stuff. Um, so yeah, I mean, it's a combination of markets at all time highs, a lot of credit, a lot of crazy behavior, a lot of interest in this kind of stuff where you didn't see it before. Um, I think are all some of the signs that we're getting close to the top.
yeah. Is it also a part of denial where I think there was one in here where really good saying prices may flatten but they will not fall, and is these like the famous last words or a bit of like
Yeah,
a bit of that
exactly,
fallacy that you
exactly.
go people are holding on to this and it's always going to be bulletproof as
Yeah,
opposed
yeah,
to hey we've been through cycles, and the cycles like you said you predicted and picked quite a few of them going it's just a matter of time.
yeah, yeah. So what I was trying to say, I mean, there's a couple of things I wanted to say with that. I mean, yes, one is this sort of great sort of declaration that we've. I think there was a Yale economist in the 1920s called Irving Fisher who said that the Dow has reached a permanently high plateau. Um, so there's that sort of idea that actually, basically, what they're saying is these high prices are totally justified, and they're not going to come down because everyone recognizes they're justified, and so they're going to pay that. It's that sort of idea that the market has reached a point where it's not coming down. But the second point I was making with that is when you get to the peak of the cycle, when it's really sort of speculative, it's actually impossible for prices to be stable at any level. So when more money is going into the market, it pushes prices up. When that flow of money slows down a little bit, prices can't stop. They have to either go up or they go down. They're not going up; they're coming down. And so it's you might see this sort of period just before it starts to crash, when it looks like things have stabilized, but actually it's the money is coming out, and it's the people just haven't woken up to the fact that it's panic is about to ensue. So I was trying to do two things with that sort of statement, but yeah, that's the sort of thing to look out for.
Thanks very much. Mate, this isn't a loaded question. I want to speak very freely as we wrap up. But people come out with, say, opinions. I'll go back to, say, Kiyosaki or Dent, for example, and they've got like a speaking
Yeah,
tour coming up, or they've got a course that they're selling, for example. It's like
yeah,
we've got a couple of economists here, from banks, and they're going, hey, we're going to see rate rises through the year, and you feel like they're pushing an agenda with their message. Either it's to get some media attention,
mm,
or maybe to sell a course or even a book, for example, and someone look at you
hmm
going, "Hey, mate, is there an agenda here, or are you just freely giving out this information for the betterment of other investors?" That's not a question to offend. It's just more to go,
yeah, yeah, yeah.
take me through like the philosophy that you got. Is just something you go, well, I just got a message that I want to share. What's the where do you come from
Yeah, it's hard to it's hard to distinguish because obviously I am selling a book. I'm
as am
selling an
I? I've got a book,
opinion.
and go. I don't have
Yeah,
an
yeah,
agenda, but you put work into it. That you go, I've got a message here, and it's
yeah,
more research.
exactly.
Yeah,
And it's a sort of it's you put all the work in up front, and then each time you sell another one, it's it's a bit of profit. Um, Look, it's a very fair question. I also have a sort of thing behind it. I have newsletters and other things
Yeah.
which the book helps to build credibility. Um, the only thing I would say is one is the motivation. I mentioned at the start that my family's business had a lot of trouble. I wanted to find out what went on, and I wanted to produce a body of work that would help us um, be prepared for the next one. I basically wrote the book that I wish I'd owned in the run up to the global financial crisis. And I saw the enormous kind of difficulty it caused us and other families who were either involved in the business or in other businesses. Um, and it's a difficult time to deal with a crisis. It causes families to split up and all these things. And I just don't want that to happen. Our societies are much worse off when we're all sort of fighting with each other because of difficult external circumstances. So that's the motivation. And the second thing is, and with all due respect to kind of Harry Dent and Robert Kiyosaki, um, I believe that what I'm saying is based upon a fundamental law of economics and produces pretty stable predictions which don't change all that much over time. I mean, as I mentioned, it might refine the timing and so on, but the reason why we make the predictions and often the timing rarely changes. And so there's that kind of consistency over time, and we can say things years in advance. Um, and we don't really kind of change it when we get close to the time. I think you might find if you've been a follower of Harry Dent for a number of years, that he's often calling for a crash and it doesn't come, so the crash is coming next year, or is it? So there's an element of that. Robert Kiyosaki, who appears to be kind of a ranty Twitter user at the moment, has actually now become quite interested in crypto, which is interesting. I think it will be interesting to see what he says in the next few months as crypto goes up, as I believe it will. He'll probably become a real devotee, and it will be interesting because he'll probably get some quite prominent following for that. Interestingly, his entire rich dad, poor dad kind of thing, he's a great believer in buying assets which generate income, which you then reinvest, which is a perfectly sound, but it describes what a lot of property investors do. And interestingly, if you look at when he started, it was around, I believe, the mid 1970s, which was very much at the start of that 18-year cycle, which ran from about 72 and peaked in kind of 88. So he's basically, his entire sort of wealth and his way of his notoriety and his example of his success, it's entirely down to the 18-year cycle, which I find sort of quite funny and quite ironic, because he doesn't quite seem to have attributed it to that. And this is what you also find, I think, with a lot of experts, is that they may mistake investment skill for simply a bull market.
That's spot on.
In a bull market, rising tide is lifting all ships. It's actually not particularly skillful to make money in that environment. What it's really skillful to do, and I'm going to say that I'm yet to prove that I'm better than other people in this, is that you preserve it during really difficult times, and indeed even prosper during difficult times. And that, I think, is a way you really kind of separate who's good from bad.
Yeah. Man, thank you very much. I appreciate appreciate a little detail on that question. Like I said, I've been such a big fan. That's why when I reached out, and again, a testament to yourself that you said you make yourself available, that you want to share your message as well. But to read this book, mate, it's not a light read, because I think it's quite confronting at times, isn't it? And when you start to piece it together, you may have this confirmation bias that, especially what we've got in Australia, that property will always go up and continues to go up.
Yeah.
What you're saying is come back to reality a little bit, and that we do
Yeah.
walk in this cycle. And I think that's probably where we do need that reality check. And as investors, I love that saying in the Big Short, which is the hot hand fallacy, right? You just keep shooting threes because you've had success, and it's going to continue to always be a success.
Yeah.
That it breeds that winner's curse, and that's where it really kind of had that penny drop moment for me. So, mate, I want to say thank you so much. I really, really appreciate your time, really appreciate your energy as well. If people want to connect you to, what's the best way to kind of follow your work and be in touch with what you're putting out there, Akhil?
Yeah, so probably a couple of things. You can follow me on X. My handle is Akhil G Patel. I also so the handle for the subscription business that I run, and we have a free weekly newsletter which people can sign up to, is at Property Share M1. So it's Property Share Market Economics, but the handle is Property Share M1. And as I said, you can sign up for a free weekly newsletter. You can get some insights about the cycle. Please read my book. You also get other insights about it. And if that is something you want to find out a bit more about, then you're welcome to subscribe to our service. But we put plenty of free stuff out there, and the book is not particularly expensive. So I think you get quite a lot of value for a relatively modest outlay.
Absolutely. And for anyone listening, whenever we get an author coming on here, I always give away a book. So I'm gonna do it for fastest fingers first. Whoever wants to drop us a DM, let us know what you loved about this, and if you got some insights, please share with us as well, and we'll give away a copy to Akhil's book. Like we always say for our listeners, I want to say thank you very much for tuning in. If you found that helpful, let us know. We love it when people reach out to us as well. But more importantly, we don't care about subscriptions or likes or thumbs up. What we care about is people sharing the message with someone else. So if you know someone that's in the market that's been talking about this property cycle, or is a bit curious and you want to educate or share this message with them, please do. We want to amplify what we're doing here so we get more great guests on like Akhil. Mate, thank you very much. It's probably bedtime for you. So
I've got to go and walk my dog now.
What have you got? What dog you got?
I've got a miniature schnauzer. Of course, she's sleeping over there. So yeah. She might not want to go out.
Mate, I want to say thank you so much. I really, really appreciate it. I look forward to seeing what you're putting out there next.
Brilliant. Thank you so much for having me.
Thanks, Akhil. That's a wrap for another episode of the Australian Property Investment Podcast. We'll talk to you next time.